Friends, there's a number buried inside the United States government's financial statements that almost nobody talks about, but I think it might be the most revealing number in all of modern finance. That number? $42.22. For those familiar with it, this makes me think about the Hitchhiker's Guide to the Galaxy. But we're not talking about the ultimate question here. No, what we're talking about is the official price at which the U.S. Treasury carries America's gold reserves on its books. That price is $42.22. It has not changed since 1973. Now, here's what makes this interesting. As I'm recording this, gold is trading somewhere around $4,500 per ounce. That's a whole lot more than $42.22, right? And get this, the United States holds 8,133 tons of gold, assuming it's all still there. That's the largest gold reserve in the world. Yet the U.S. government only values it at less than 1% of its current market value. Why is that? Somebody made a choice to freeze that number in 1973, and nobody has bothered to change it since. So I have to ask, why? You know, that question is what today's episode is all about. Hello and welcome to episode 8 of the Phoenician League podcast. I'm your host, Joe Withrow. Last week, we spent a lot of time assessing the plumbing within the financial system. We talked about the transition from LIBOR to SOFR and how that signaled something much bigger than just a technical accounting change. The core takeaway was this. In 2022, we moved away from a system built on paper, self-reporting, and manipulation to a system built on verified transactions, secured collateral, and real assets. And I said at the end of that episode, real assets are reasserting themselves right now. Today, I want to take a deeper look at gold, which is the oldest real asset that there is. It has somewhere around 5,000 years of monetary history. And right now, something genuinely significant is happening inside the gold market. And it's something that most investors are missing. And I think that's mostly because they've been conditioned to dismiss it. So today we're going to answer that question about the $42.22 number. We're going to look at why gold got demoted in the first place. And we're going to look at 6 specific structural forces that are reshaping the gold market right now. And then we're going to look at some data points that I think might surprise you. So let's start at the beginning. For most of recorded human history, gold was money. Not just a store of value. It was actual money. It was the medium through which people conducted commerce and settled their debts. And the reason gold works so well as money is simple. Nobody can create it out of thin air, right? You've got to go find it. You've got to mine it, dig it out of the ground. You've got to refine it. You know, it takes real work and real resources to produce gold, which means you can't just print more of it when governments want to spend money that they don't have. So that's a feature. But governments over time came to see it as a bug. In 1944, after World War II, the Allied nations gathered in Bretton Woods, New Hampshire, and established a new international monetary order. They called it the Bretton Woods system. Under Bretton Woods, the US dollar became the world's reserve currency, and the dollar was pegged to gold at $35 per ounce. Every other major currency was then pegged to the dollar. So fundamentally, it was a gold-backed system, just once removed. The dollar was the intermediary, and gold was the anchor. Now, this worked reasonably well for about 25 years or so, but it carried a fundamental tension inside it because the U.S. government started running large fiscal deficits, especially to finance the Vietnam War and the Great Society programs that they spun out. And so the U.S. government was printing dollars to service those deficits. So foreign governments started to notice that there were now a lot more dollars in circulation than could be backed by the gold that the U.S. held at Fort Knox. France was particularly vocal about this. French President Charles de Gaulle famously called out the United States in the 1960s for what he called an exorbitant privilege. He was referring to the ability to print the world's reserve currency and just export essentially your inflation to everybody else. So foreign governments started converting their dollars to gold. And then the U.S. gold reserves, they started draining. Gold started flowing out of the United States, meaning the U.S. government had to send its gold to the countries who were turning in their paper dollars. Well, they didn't like that too much. So on August 15th, 1971, President Nixon went on national television and announced that the United States was suspending the convertibility of the dollar to gold. And just like that, the anchor was cut loose. That's when the dollar became a pure fiat currency, backed by nothing but the full faith and credit of the US government and the willingness of the world to accept it. So in 1973, the U.S. Treasury repriced its gold reserves at $42.22, and that's up from the $35 an ounce to account for inflation. Then that number was never changed. Now, in the years that followed, the financial establishment worked very hard to convince everyone that none of this matters. It's almost like gold was disappeared from the system and from its history. Famous British economist John Maynard Keynes had famously called gold a barbarous relic. And that phrase just got recycled constantly in the post-1971 world to justify the new fiat monetary arrangement. And, even Warren Buffett piled on after he got famous. Buffett equated gold to this pet rock that you pay people to dig out of the ground, then you pay other people to store in a vault and guard for you. So he had this very negative view. And that view of gold shaped the post-1971 narrative. And for a long time, the argument it probably seemed to hold up for those who weren't paying attention too closely, because what replaced gold was the age of paper wealth. If you listened to last week's episode, you know what I'm referring to here. Interest rates fell for 40 years, from 1982 to 2022. So from 1982 to 2022, credit expanded and debt levels soared throughout the economy. The financial system became flush with this liquidity because of the credit that was expanding, because of the debt. And that liquidity chased financial assets higher and higher. Stocks, bonds, all kinds of different funds, all of them went up more or less consistently for most of that period from 1982 to 2022. Of course, there were dips, there were exceptions, but generally from that time period, the trend was higher and higher for financial assets. In that world, the world of perpetually falling interest rates and abundant cheap credit, you really didn't need gold. You didn't need a monetary anchor when the tide was just always coming in and lifting all boats, right? The establishment doubled down on this view in 1999. They seemed to genuinely believe it. And that was when Gordon Brown announced that Britain was going to sell off more than half of its sovereign gold reserves. And then he did something unusual. He announced the sale in advance, which of course drove the price of gold lower before the Britain even sold its first bar. So the numbers suggest that Britain unloaded something like 395 tons of gold at price levels between $256 and $296 an ounce. And so it was right near the bottom of a multi-year bear market for gold. And so that episode became known in history as Brown's Bottom. And for those paying attention to this kind of thing, it's widely considered one of the worst government investment decisions of the modern era. But I don't want to spend too much time piling on Gordon Brown because he was not operating in a vacuum. He was operating within this dominant worldview that existed. The age of paper wealth was really at its peak in the late 1990s. And they were adamant that, gold pays no yield. You buy gold, it doesn't return anything. It pays no dividend. There's no productive activity that occurs. And they're looking at it and they're saying the financial system, it's flush with liquidity. So why do you hold this relic when financial assets were just getting everyone rich, at least on paper? Well, all of that came crashing down in 2022 when SOFR replaced LIBOR, as we discussed last week. Then the Federal Reserve raised interest rates, I think it was 11 times. And it was the most aggressive tightening cycle in 40 years in terms of the rate of increase from which interest rates went from basically zero to, I think it was 5.25% at the peak. That was the fight, even though 5.25%, that number is not eye-popping. It was the rate at which it moved from 0 to 5.25% was astounding. So that's when the architecture of the old financial world broke down. Meanwhile, gold quietly hit a new all-time high, and then another, right? Now, I want to be direct about gold's move. It's been driven by structural shifts within the system. It's not just about being an inflation hedge or any of the usual explanations that you'll hear on financial television or wherever. What's happening in the gold market right now is structural. And to understand why, I want to walk you through 6 specific forces that are reshaping the gold market from the ground up. Before we do though, I just want to emphasize when I say it's structural, I don't mean that gold's never going to go down. I don't mean that gold's not going to have periods where it corrects. What I mean is that gold has been repriced because of these structural forces, and it's not going to crash back down, to $800 an ounce, right? There is a floor somewhere at these elevated levels because of these structural forces. All right, so a research firm in Liechtenstein has been publishing an annual gold research report since 2007, and they call it In Gold We Trust. It's the In Gold We Trust report. So in 2020, at the height of the COVID hysteria, this firm published their 14th annual edition, or maybe it was 13th, whatever it was. They published that year's edition of the report, and they made a projection that was widely ignored at the time. They predicted that gold would reach $4,800 per ounce by the year 2030. So gold was trading somewhere around $1,800 an ounce when they made that call. So they told everybody that it was going to nearly triple over the coming decade. And that was considered to be quite a bold call at the time. But guess what? It wasn't nearly bold enough, was it? Gold ripped through that $4,800 price level earlier this year before then pulling back to the levels where it's trading currently. So I kind of chuckled when I read through the 2026 version of this firm's report, which just recently came out, because now this firm is calling for gold to hit $8,900 an ounce by the year 2030. All right. So they're adamant about this. They raised their price projections. But again, there are several structural forces driving this move. It's not just financial momentum. If it was, gold would probably have already crashed. With how rapidly it appreciated in value in terms of dollars, it probably would have crashed by now if that was just financial momentum. We've seen that time and again with certain assets. But that's not what happened. Instead, gold's consolidating really around this price level at $4,500 an ounce. So the first force underlying this is geopolitical sovereignty. This one really accelerated in February of 2022 when the Biden administration and the European forces that have been pushing, for permanent war with Russia, they froze roughly $300 billion of Russia's dollar-denominated foreign exchange reserves. So that move sent the signal that the dollar could be weaponized. It meant that holding your reserves, if you're a country that people decide they don't like, holding your reserves in U.S. Treasury bonds or in any asset held within the Western financial system, that suddenly carried a serious political risk. Now, I do think the Trump administration has been working to do damage control with that situation. And I think they've been trying to rebuild trust in the Western financial system. But the reality is that central banks in emerging markets like China, India, Turkey, there are dozens of others, really. They've been routinely adding to their gold reserves over the past several years. So in a fragmenting multipolar world where financial sanctions have become a standard geopolitical tool, gold went from being just this relic to being really geopolitical insurance for those who are at, the central bank level, at the national government level. And it's not just the emerging market central banks either. Now we're seeing data that the Western central banks are starting to add to their gold reserves as well. And that's really the second structural force at play here. Because for most of the past 40 years, Western central banks really were net sellers of gold. The dollar was dominant, so interest-bearing bonds were more attractive as reserves than this, yellow metal that pays no yield. So Gordon Brown was not alone in selling. The IMF, I believe, sold some gold. I think the Swiss sold some gold. European central banks sold gold throughout the 90s and the 2000s. But that's all changed. Western central banks are now net buyers of gold. And that's really the first time in over 10 years. All right. So the third force underlying the structural shift in the gold market is private and institutional demand for physical gold. And I think that's just beginning. Now, it's a little humorous to me because despite gold's extraordinary performance in recent years, private institutional allocation of gold remains almost non-existent still today. The numbers I saw suggest that gold represents roughly 2.7% of global financial asset allocation today, 2.7%. And the data shows that 72% of global family offices, and these are the people that are kind of managing the largest concentrations of private wealth in the world, they currently have 72% of them have zero exposure to gold. None. They don't own any gold. So that means the largest pools of private capital have essentially sat out this entire gold bull market that we've seen. The institutional adoption curve, it hasn't even really begun. So that I think is interesting, but there's evidence that these institutions are starting to catch on. So JP Morgan is now out there recommending a 4 to 5% gold allocation to its private clients. And Morgan Stanley is going even further. They are now recommending what they call a 60-20-20 portfolio. And they're saying it should be 60% stocks, 20% bonds, and 20% gold. For them, that's absolutely radical. So last week, we talked about how the 60-40 portfolio was the backbone of Retirement Incorporated and, how it got crushed in 2022. That's when the architecture broke down. So now Morgan Stanley is one of the very institutions that sold that kind of age of paper wealth architecture for decades. Now they're quietly recommending replacing a significant portion of their previously suggested allocation with gold. That's not a minor portfolio tweak. That is the establishment implicitly acknowledging that the old model is broken. And when Morgan Stanley changes its recommended allocation, I do think that's going to move real money. When 72% of family offices sitting at zero gold exposure, when they start reading these suggestions from these large iconic institutions, at least from their view, they're probably going to start moving money into gold. And if they moved even, say, 5% of their assets under management into gold, that would be a very big deal. All right. So the fourth structural force undergirding gold brings us back to our magic number of $42.22. And the balance sheet math that implies, right? There's something that I don't think really many people have picked up on. So the United States holds 8,133 tons of gold at $42.22 per ounce on its balance sheet. Okay, that equates to just over $11 billion worth of assets on the federal government's balance sheet. And that's sitting opposite to this massive and growing mound of national debt, right? But at current market prices, the actual market value of those gold reserves, it's well over $1.2 trillion, right? So that's a gap of around almost the entire $1.2 trillion between what's currently on the books right now and what's actually in the vault in terms of market value. And the serious question, or the question that I should say that the serious policy thinkers are now asking publicly is, well, what if you close that gap? What if the U.S. Treasury simply revalued its gold at market prices? If they did that, nearly $1.2 trillion would appear on the balance sheet pretty much overnight, right? And that's without borrowing a dollar. It's without raising a tax. It's without printing a new note. None of that. It's just an accounting entry. So in a moment where the U.S. government is staring at these rising fiscal challenges that seem almost intractable at higher interest rates, adding over $1 trillion to the balance sheet, that's not an insignificant number. Of course, it's not a panacea either. There's still a massive fiscal gap, but that would be a material move. We tend to focus so much on the liability side of the federal government's balance sheet, and that's with good reason. Congress spends money like drunken sailors, and we're learning that there's massive levels of outright fraud embedded in the fiscal deficit also. But we do seem to forget that there's also an asset side of the balance sheet. And the bigger that asset column is, the less catastrophic the fiscal situation could potentially become. So I think that's something to watch. And that ties into, the sovereign wealth fund idea that these guys have too, which, free market purists are going to rail against that, and they have. But I do have to acknowledge that there is a practical element at work to that. What if the U.S. government stopped wasting money and just started building assets instead? Nobody ever considered that a possibility before. And I'm not saying that that's what you want in your system. I'm not saying that that's the ideal thing. I'm just saying in the situation we're in today, I can see a practical application there. I can see how if somebody said, we need to save this thing. This ship's going down if we don't do something different, if we don't change course. I can see how you could say, okay, well, let's start building assets, right? Let's revalue our gold. Let's create a Bitcoin strategic reserve. Let's start taking equity positions in these companies, right? And let's start getting dividends, and let's having those dividends compound on the balance sheet side, and let's start selling off and leasing out this massive swath of federal land that we own. You can see there's options there if somebody were to seriously consider them. So I do think that's something to watch. Again, I'm not endorsing those moves. I'm not suggesting that that's what you want in your economy, but I am suggesting that that is an option that's in play that I don't think many people have given, real consideration to. All right. So the fifth structural force that's underlying gold's move is the digitization effort. And I don't want to spend too much time on this, but it is worth noting. There are several projects out there working to tokenize physical gold, which means they're creating a digital blockchain-based asset that represents physical gold bullion that's held in a vault. So tokenization does not change the underlying gold, but it could make gold dramatically more useful as financial infrastructure. If you can own fractional amounts of gold down to maybe a single gram, and if you can transfer that gold instantly across borders in a frictionless way, and that allows gold to seamlessly kind of integrate into modern digital financial systems, there's something to watch there. So the tokenized gold market hit roughly $178 billion in trading volume last year. And Tether, which is the company behind the world's largest stablecoin, it's been buying physical gold at a pace that rivals major central banks. And that's to back its digital gold asset, which I believe is XAUT. So remember what we talked about last week. The new financial architecture is built on collateral. It's built on secured, verifiable assets. So tokenized gold becomes collateral in that system in ways that perhaps a bar of gold just sitting in a vault never could. Gold is becoming part of the infrastructure, not just a savings vehicle. All right. So to tie it all together, the U.S. Treasury's gold reserve has been valued at $42.22 an ounce since 1973 because the entire establishment consensus of the age of paper wealth said that gold was this barbarous relic. They saw it as an irrelevant holdover from a world that financial sophistication had made obsolete. But the establishment was wrong about gold in the same way that it was wrong about Retirement Incorporated and the 60/40 portfolio. And that's because they built their entire framework on the assumption that interest rates would always go down, credit would always be cheap, and then the twin forces of globalization and financialization would always expand and would never reverse. So they thought the age of paper wealth would last forever. At least that's what it appears to me. But it didn't. It died in 2022, as we discussed last week. The Phoenician merchants of the ancient world understood something about the value, or something about value itself, that I think the modern economists forgot, certainly the mainstream ones. And that is, the medium of exchange could change, that trade routes could shift, the political landscape could be redrawn, but the things that were real, the things that took work and resources to produce, those things tended to hold their value across centuries and across civilizations. And that's why gold has held its value across 5,000 years of human history, at least. Empires over that time rose and fell. Paper currencies came and went. In fact, paper money itself was invented and then debased 100 times over or more in that time period. But gold remained. So I would like to suggest to you that gold is very quietly being reintegrated into a new financial architecture as we speak. They'll play it down for as long as they can, but it's happening all the same. Our system is going to look much different in 2030 than it does today. And friends, next week, we're going to take everything we talked about today and we're going to introduce the digital twin, which is Bitcoin. Now, I know some folks are still skeptical of Bitcoin. That's, I'm sure, especially true now that Bitcoin has pulled back over 50% from its recent all-time highs. Now, I've seen that same mindset for over a decade now. Guys, I've been in Bitcoin since 2014. So I've lived through every cycle, every crash, every Bitcoin is dead headline, all of it. I'll share some of that story with you next week. And we'll also look at Bitcoin's role in the new financial architecture. That's what's on tap for episode 9. And I'll see you then. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at phoenicianleague.com. We often send out detailed written analysis on the various investment opportunities in the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at phoenicianleague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.